Okay, so welcome to this new video. In this video we're going to talk a little bit about some of the theories, some of the ideas that we discussed in the previous video, but more in practical terms. And we're going to look at some of the things that we discussed on a chart. And so we spoke about the moving average thing, but the problem with moving averages is that you can have moving averages that do this. And if you're looking for crossovers all the time, you might be fooled and say, well, actually, we're probably going to buy, but in fact, it went down. Then you thought, okay, well, maybe we're going to sell. But in fact, it didn't go down. It just went back. And so you took a loss there. Okay, we're going to buy. But in fact, it just was deviating from a mean and then reverting to it. Okay, so we take a sell. We lose all the time. So this is essentially death by 1,000 cuts, which is super annoying. So when prices are doing this, you don't want to be trading. You want to be doing something else, because this is bad for business. This is really bad for us. And so this is why we're going to leverage something called the Hurst exponent. And the good thing about the Hurst exponent is that it's a really good way for us to see if prices are acting completely randomly, like we discussed in the last video. And this is something that where you can discuss the Brownian motion, which is where prices are acting randomly. So if you look at a coin flip and you take a coin, you flip it 100 times, the likelihood that there's going to be an equal distribution between heads and tails is pretty high. Okay, and so in a situation like that, the Hurst exponent is going to be equal to something like, or closer to 0.5. Okay, because this is 50% higher, 50% lower. But what happens in the situation where you have a coin that is not equally distributed in weight? So you have maybe a side that's slightly heavier, a side that is lighter. I mean, how is this going to affect the outcome of coin flips? Well, I think it's probably going to affect it in one way or another. Okay, and so it's going to be slightly lopsided. And so in a situation like that, well, then the Hurst exponent is going to do something different. It's going to give a different value, okay? And that value is probably going to be bigger than a 0.5. Maybe it's going to be 0.6, okay? And this tells us that the data is skewed. It doesn't tell you in which direction it's skewed. It's just telling you that the data is indeed skewed. And this is very interesting. This is very good. Okay, and so when you have a Hurst exponent and the value is greater than 0.5, let's say 0.6 or greater, this is telling us that the data is exhibiting trending behavior. Okay, but if we take it one level further and we say, okay, what about a Hurst exponent that has a value that is, let's say, 0.3? What does that mean? It's telling us that the data is doing something entirely different. This is more mean reversion behavior, where prices kind of deviate from a mean but have a tendency to revert back. So essentially, if you go back to the coin flip example, it just means that the coin is a little bit jumpy. Okay, so if it lands on its heads, then it must land on its tails next. Okay, and so the whole process of trying to identify a trend or a bias in one direction or the other is not present. Okay, and so we have mean reversion behavior. And so the Hurst exponent is really good. It's a really good way to tell us if prices are more likely to move in one direction or they're more likely to stay roughly where they are. So in a situation like that, we have done a few things already. Okay, so we found a way to roughly decide if market is trending, and we're looking at a moving average. So we have our trend, which we're going to use the moving average for. This is the trend. Okay, and now we have another one, which is Hurst exponent, and this is telling us if we have trending behavior or mean reverting behavior. Okay, this is really good. And so you want to see either one or the other. And just to reiterate that one more time, if we have Hurst that is equal to, let's say, 0.6, then we seeing trends if we have a Hurst that is less than or equal to 0 point, let's say 4, or then this is mean reverting behavior. And if you have something that's between the two, well, then there's nothing to do. There's absolutely nothing to do. If your algorithm trades trends, momentum, or mean reverting. So you can use the Hurst exponent for this. Okay, and it works quite well. Okay, good. So now we have those in place. And now we need to consider for a second what we would do for stop losses. And stop losses can be quite difficult to get right. But what we can do is that we can look at something called ADR, average true range, which tells us something about volatility. Okay, so if you have a high ATR value, so high ATR is high. Okay, it's difficult to say because everything is relative, but let's say it's high relative to historical values. Then we want our stop loss to be large. Okay, well, it will be large because it's based on ATR. But if we have an ATR that is low volatility or low, well, then we're going to have smaller stops. Okay, and so using ATR as a way to gauge the expected volatility of asset prices enables us to create dynamic stop losses. Okay, so when you have really violent moves like this, swings like this, well, then we're going to have bigger stop losses. And if we have small, slightly tighter ranges like we have here, well, then the stop losses are going to be much tighter. Okay, so this is why we're going to use the ATR for that. Okay, so that's that. So we have our way to identify trend, moving averages. We are going to look at, we're going to scrutinize the data a little bit more and identify whether or not the data is exhibiting trending behavior or mean reverting behavior. So that's number 2. And then number 3 is that we have a way now to define stop losses based on volatility. Okay, so that's pretty good. I think that's a pretty good kind of 3-pronged strategy for building an algorithm. Okay, and so now if we jump to a code editor, I've already added these in. And so we have our fast moving average. And again, this is looking at, we have a slow moving average, and then we have a fast moving average. Okay, so this one here is going to be this one. And this one here is going to be this one. Okay, so we want to be able to see where the slow moving average is, where it's moving relative to the big one. Okay, and then we have the ATR periods. I'm going to use a standard one. I mean, everyone is using 14, and so I'm going to use 14 as well. Okay, I don't want, there's no magic, there's no edge in using 12 or 79. It doesn't make sense. Just use what everyone else is using, and that's what we'll do. And here we spoke a little bit about the stop loss multiplier. Okay, so here if we have a stop loss, let's say that the ATR is 6. Okay, so the average true range, as an example, for the pound American dollar on the 1 hour chart is 6. That means that it's expected to move about 6 pips during that hour. Okay, if it's expected to move 6, how about we take that and we multiply it by 2. Okay, so we are expecting 6, but our stop loss is going to be placed at 12. So we have a little bit of protection from volatility or unexpected volatility. So if volatility moves outside that expected 6, then there's still a bit of a cushion. And so we're not going to get taken out of our trades because we have a slightly larger value. Okay, and then here we have, this is the stop loss, and here we have our target. And so now we take, go like this. This equals the stop loss, and then our stop loss is going to be equal to this. And then for our target, we want to say that we want to multiply that by 4. Okay, and that is our target. And so essentially in this calculation here, we would have a 4R should our trades go to our target, which is great. So every time we lose 4 trades in a row, we only have to win 1 to bring ourselves back to break even, theoretically speaking. Okay, not entirely true because the account balance will go down if you're looking at percent risk per trade, then it's going to be a little bit more than that, because we have to make back what we lost in order to first be able to build up profit. And so it gets a little bit, the calculations are different, but we shan't talk about those here. Okay, and then we spoke also in the first video, the last video, about a trailing stop. Okay, trailing stops can be a good idea because when prices start to move in your favor, then we are constantly taking our stop loss and we're moving it close to price. So if we have price here and price continue to go higher, the stop loss is moving higher and higher to the, or closer and closer to our entry. So we're reducing the risk of a full stop. It's good because you reduce risk, but it's also bad because you can choke trades out. So having a multiplier, so if we had a multiplier of 1, we would, going back to this example, every time the trade went into profit, we would move the stop. The stop would constantly be moving 1 R behind the actual price. And so you can choke this out quite quickly. So what we would do here, maybe we would set this to 2, so it's the same as our stop multiplier that you can see here. That might be a good idea. Okay, and then here we have lots. We can put a static loss, we can use dynamic. Okay, we're going to risk 0.5% per trade. We have our slippage here and our magic numbers. That's fine. And this takes us to our next section, and this is the daily limits. I mean, if you have an algorithm and we keep taking losses over and over and over again, maybe that day that the market isn't acting as it should, it's not acting in a way that is beneficial for our algorithm. And so let's say that if we lose 2% in one day, then we shut down for the day and then we wait for the next day to begin trading. Okay, that can be a really good way to stop bleeding. Okay, so if you have for whatever reason the market is not doing what the algorithm is expecting, then you just shut it down and you wait until the next day when things are most likely to change. You can also have a positive limit where if the algorithm pulls in 4% for that day, that's a lot. That's a huge amount for one day, 4% in one day. If that happens, then you shut the algo off and you kind of say, that's great, 4% with one day, that's amazing. I'm not going to do any more trades today. I'm going to keep that 4% and I'm going to wait till tomorrow. That can also be very beneficial. Okay, then we have a couple more values here. We have time of day filter, which I added, which is great. And this is a good idea because sometimes you only want to trade when the markets are moving. And typically the GMT, let's go to GMT maybe 8 o'clock. When the markets open at GMT 8 o'clock in the morning, 9 o'clock in the morning, this is when London opens, and this is when there's a lot of liquidity, a lot of volume moving into the market. And so this is a very good time to trade, in contrast to out of session, which is often when prices jump around because there's very thin liquidity. And so it's best to trade during liquid times of the day. So I've created a small filter here that will enable us to do that. And then we have a few other filters here. We have the spread filter. Okay, so if the spread exceeds 2.5 pips, then we don't want to trade. This means, once again, that we have illiquid conditions, and so we just want to wait. Okay, and also here we have volatility. So if the volatility is super small, then we don't want to do anything. So if the volatility is 1 pip, around 1 pip, that's not a lot. And that means that maybe price is waiting on news and it's kind of just moving sideways, like very, very tightly, or it means we're out of session and there's just nothing going on, or for whatever reason. Okay, this is not a very sophisticated one here. We could change this, and it could be, for example, a percentage of the ATR. It could be, for example, if we are maybe 25% of the ATR. Okay. If we're below that, we don't want to be trading because we're probably maybe looking at something like that. Okay, and so combining these two can be a pretty good way for us to stay out of illiquid, quiet market times, which is generally a good idea. Okay, here we have our break-even stop, which is another one I've added. Okay, and so here, if this is set to true, once price moves 1 times ATR in profit, then we move the stop to break even. And if you want to protect yourself a little bit, just say, let's make sure that we have commissions covered. You know, we'll just do 2.0, so 2 pips, you know, just to make sure that we're getting a little bit, and maybe we'll change this to 2 because that's a little bit too tight. Okay, and now we have our Hearst filter. So we're going to keep this enabled. It was disabled, I just enabled it. Hearst period, how much data do you want to use? You want to use maybe 250 for, let's do about 200. We'll start off with that. We're going to optimize all these parameters, so don't worry what that means. So we're going to look at 200 periods, and as we spoke about earlier, when the Hearst exponent is greater than 0.5, this normally means that it's exhibiting trending behavior. But sometimes it's not. So normally you want to push this up a little bit. You want it to be, for example, 0.6. If that's the value of the Hearst exponent, then normally it's trending a little bit or exhibiting trending behavior, which is a good thing. Okay, and here we have the Hearst scales. This is another value that we're going to optimize. We're going to optimize all of these values actually, but this is just telling us essentially the number of window sizes for the calculations, because this is important. We touched very briefly on that in the previous video as well. Okay, good. So as a little bit of introduction to the theory, some of the parameters, the input for this algorithm, and I think we're going to leave it at that. Okay, so I'll continue writing this algorithm, so we have something we can look at during the next video. If you have any questions, let me know, and thanks once again for watching.